Hello, welcome to Accounting Hub. I'm Professor George Scarpin, PhD in Accounting, and our topic today is budget planning and control. So, our focus here will be why do we create a budget? How can we use it for planning and control? And then we have a playlist with additional videos about how to do it on Excel. So first of all, a budget is a detailed quantitative plan for acquiring and using financial and other resources over a specified forthcoming time period. A company budget ordinarily covers a 1 year period corresponding to its fiscal year, usually from January to December. However, some companies also use a perpetual budget, which is 12-month budget that continually rolls forward. What is the difference? Let's suppose that we are in March. So on a regular budget, that starts on January, ends on December. We are in March, so our budget will cover from April to December, 9 remaining months. If we are on a perpetual budget, our budget will cover from April to the following March. So always 12 months. So perpetual budget, we need to create 1 month budget every month. So it's more expensive to work with, more labor to do, but a better info. So here, operating budgets ordinarily cover a 1 year period. Many divide their annual budget into 4 quarters or 12 months, and a continuous budget is a 12 month that rolls forward 1 month or quarter as the current month or quarter is completed. So here, operating budget, 1 year budget. More than 1 year, we are talking about uh, investment, we are talking about payback, net present value, and so on, not about budget anymore. So two purpose of budget: planning, developing objectives and preparing various budgets to achieve those objectives, and control involves the steps taken by management to increase the likelihood that the objectives set down while planning are attained and that all parts of the organization are working together toward the goal. So planning and control. On a planning perspective, what is the benefits? Define goals and objectives. Think about and plan for the future. That is very, very important. Means of allocating resources, uncover potential bottlenecks, coordinate activities, and communicate plans. On a control perspective, oops, improve the efficiency and effectiveness of operation, evaluate and reward employees. So on a planning perspective, so our budget sales is $1 million for the next year. The next year arrives and our actual revenue was $900,000. So one perspective planning, 1 million. The second control, 900, and we are $100,000 short. So we need to check what happened. But if I don't control it first, or if I don't plan it first, I cannot control it later. And how do they create budgets? Companies usually create budgets by relying on some combination of top-down budget and self-imposed budget. So top-down, the top management decides the budget. Self-imposed or participative budget is a budget that is prepared with the full cooperation and participation of managers. And here, not only companies, but any kind of organization, public, private, profit, non-profit, etc. And the self-imposed, we start with the supervisors and then they send it to the middle management, they send it to the top manager. So it is self-imposed budget. So the top manager coordinate the process instead of doing the budget. Advantage show respect for the opinion of the lower level managers. Budget estimates prepared by frontline managers are often more accurate because they know what they are doing. Motivation is generally higher when individuals participate in setting their own goals and empowers them to take ownership of the budget. Self-imposed budget should be reviewed by higher level to prevent budgetary slacks. Okay, I define my goals. I will define goals that are easily achievable. So we need some higher level management to review it. And most companies issue broad guidelines in terms of overall profits or sales, and lower level managers are directed to prepare budget that meet those targets. And here, let's see some big picture of the budget or the master budgeting. So let's see the big picture. We have 10 schedules in the master budget. We will see them later. And they are designed to answer 10 questions. How much sales revenue will we earn? How much cash will we collect? How much raw materials will we need? How much manufacturing costs will we incur? How much cash will we pay to our suppliers, direct laborers, and so on? What is the total cost that will be transferred from finished good inventory to cost of goods sold? How much selling and administrative expenses will we incur? How much money will we borrow from or repay to lenders? How much operating income? What will be our balance sheet? So it looks like financial accounting here. So it looks like what financial accounting does, but we do it without journalizing, without debits and credits. And what is the master budget? So we start with sales budget, then we move to production budget, where we find our inventory budget to find our ending inventory. Production budget, remember, production costs, direct materials, oops, direct labor, and manufacturing overhead. So it is our budget and also the selling and administrative budget. So if we have the sales budget, inflow of cash, production, outflow of cash, selling and administrative expenses, outflow of cash. We have the cash budget. We only need to add the capital investment. So if we are purchasing equipment and so on, with cash budget, we can find an income statement. With income statement plus cash budget, we can find the balance sheet. So over our playlist, we have one video for each of these 10 master budgets. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Yes, so we have one video for each the 10. So please go on our playlist, check our videos. They are very, very useful. So thank you so much. If you have questions or comments, leave them here or email me. And subscribe to our channel. You will be the first one to know when a new video arrives. Have a very nice day and God bless you.